All right, for our next case study, going back to the question, do I need to have a lot of money to start a whole life insurance policy, a high cash value life insurance policy? Short answer is no. We examined a 25-year-old male and a 35-year-old male. Now we're going to look at a 50-year-old male. Cash flow we're going to allocate toward the policy is $10,000 per year for 10 years. Should he pay longer? He absolutely can. He doesn't want to. He wants to stop at age 60. And that's something, whenever we design a policy too, these are great examples, but you can customize it where you can elect to go for a shorter or longer period of time. You don't have to choose all of that on day one because life happens, things change. Now what we're going to look at, same thing we looked at for the 25 and 35-year-old. Maximize that 10K right off the bat, meaning of the $10,000 I'm paying in, we've got a $1,000 base premium, juicing the policy, and I cannot add more money to it. That's the drawback to a max funded policy. When I say max funded, we set the limits and we maximize it right off the bat, optimizing cash value. Versus building in window room. I have the ability to add more money. How much more? In this example, we're going to look at a $25,000 MEC limit and a $2,500 base premium. So I'm going to pay in 10 with this option, but I've got the ability to go up to 25. We can construct a policy like that. And I really like that kind of stuff because, you know, when I think life insurance, a lot of times I think boring bill, I got to pay the same amount, I'm locked in. But when people hear, hey, you can add more to an existing policy, you get a bonus, you get extra funds, you want to enhance your death benefit, you can throw money into a policy. And you can do it without underwriting if it's set up right and the company allows it. That's a whole nother topic. My point is you can be very creative. You can kind of use a policy more as a flexible savings asset, not just a boring insurance bill. Let's put it that way. So let's continue on here. To touch on this, very briefly, if I'm paying $10,000 per year into a policy, because that's what we're going to look at here, if I have a 1K base premium, in this example for the 50-year-old, we're using a different company, so the company is going to overcharge me only in the first year. Beginning year 2, that comes back to work for me, the minimum premium. PUA dollars, show up in cash value, accessible, also purchase me additional death benefit, which is nice. Then I've got my limits. Insurance company limits, 10x base premium. This company is very similar. The true figure would be 11x because I can 10x my base in PUA, so it's 10x on top of the base. Doesn't make a huge difference to that level every time we look at it. But as we continue, the other thing to look at is the MEC limit. So for example, in the option where I want to build in more window room, we are going to set the MEC limit at $25,000. Let's take a look. Here we go. So, like the other examples, max funded policy, meaning of the 10K, I'm juicing it as much as I can right off the bat. Build in more window room, I can pay up to $25,000, but I'm only going to pay in 10K. How much does that extra window room cost me, and how much does it hurt me if I don't add more money? Because I'll say this, if we add more money, it's often worth building in the extra space. If we don't, that's where I can get hurt. Because now I've purchased, now the death benefit, if I needed the death benefit, it was worth it. So let me kind of retract there. But if I'm laser focused on the cash value, that's the kind of stuff I want to be aware of. Crossover between 7 and 8. Over here, crossover between 4 and 5. For a 50-year-old male paying in 10K per year for 10 years. By year 10, $9,800 difference in cash value, about $10,000. I paid in 100. I mean, that's a year's payment as far as my annual outlay. So it is, I mean, that's significant with the numbers we're looking at here. We want to be aware of that stuff up front. And as time passes, this is just compounding from this point forward. So yeah, it's going to gradually pull ahead. But I want to be aware of that stuff. Let's provide a little bit more detail. Here we go. So if I'm cash flowing a policy, what's my question? Where is my money going? If I'm paying in $10,000 per year, where can that go? Premium, PUA. I've got a term cost in there as well. Here's my base premium. That purchases me a whole life death benefit. This is that standard non-smoker here. This target additional benefit is my term rider. Specifically a 1-year term rider. There's the initial cost of it, and it's actually set up where it decreases over time. The net cost. Total payment, $10,000. And there's my PUA allocation, the $9K. So as time passes, well, we've got our stereo instructions here. This company does a good job as far as breaking down their illustration. Here we go. 10 goes in. There's my $1,000 base. Net cash value. You can track the break even to here, year 5. I'm positive by year 5. And then it keeps growing from that point forward. This death benefit actually gave him a $15K MEC limit. We had to overinflate it a little bit based off the 10-year funding. That makes a huge difference. This one, we had a $25,000 MEC limit. That's where the $500K death benefit came up from with a 50-year-old male. When you're age 50, it's like exact. Right? What I mean when I say exact, 500 gives you almost a clean 25K in MEC space. $1 million, clean 50,000 MEC space. 50 years old, 2 million, clean 100K in MEC space. That's not always the case, but at age 50, it is. For a male, females are different. So, same thing, $2,500 base premium, 25K MEC limit. Okay, base, total outlay, $10,000, $7,000 right off the bat. There's the cost, base premium, overcharged. That's specifically what's not showing up in the first year. I mean, the biggest objection we would always hear with whole life is I lose equity right off the bat. Yeah, it's my base premium. Can I enhance that? Yes. What are the pros and cons? Do I want a higher base? Do I want a lower one? Look at the different options. The reason for a higher base, in my opinion, is to have the ability to add more funds down the road. But our goal is and always will be, how do I maximize the short-term and long-term value of a policy, cash value and death benefit? So time passes. There's my break even and keeps on going. So we had a lot of fun with this one. I hope you did as well. If you have any questions, feel free to reach out anytime. And as always, I hope this helps. The answer again is yes. Do I need a lot of money to, the answer again is no. Do I need a lot of money to open a whole life insurance policy? No. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.